If you're looking to get your feet wet in commercial real estate, then yield on cost is one of the most important metrics to understand when weighing the risks and rewards of a real estate deal. By the end of this video, you'll be able to calculate yield on cost and know how to use this metric to evaluate a property you're vetting. Yield on cost is a critical metric that every commercial real estate investor needs to understand. It helps investors evaluate the potential returns of a value-add real estate deal, taking into account both the income generated and the costs involved in acquiring and improving that property. We'll walk through the ins and outs of yield on cost, breaking down the components of this essential metric, and illustrate its importance in real estate investing. So, what is yield on cost? Yield on cost is a financial metric that measures the current rental income of a real estate investment property in relation to the original cost of the property. It's calculated by dividing the net operating income, otherwise known as the NOI, by the original cost of the property, and then multiplying the property by 100 to express it as a percentage. For example, suppose an investor purchased a real estate property for $200,000 and the net operating income of the property is $20,000. The yield on cost would be calculated as follows. $20,000 divided by $200,000 times 100 equals 10%. This means the investor's original investment is now generating a 10% annual return through rental income. Yield on cost is a useful metric for evaluating the performance of a real estate investment over time, as it takes into account the purchase price of the property rather than just the current market value. It can be particularly helpful for long-term real estate investors who are focused on generating passive income from their properties. As the rental income increases over time, the yield on cost will also increase, providing an indication of how profitable that investment is, of how much the investment property is paying back in relation to the initial cost. Yield on cost is an especially important factor for anybody who's looking to invest in what's called a value-add deal or an opportunistic deal. A value-add deal is a real estate investment strategy where investors purchase properties with the intention of making improvements to increase their value and generate higher rental income. These improvements can range from minor cosmetic upgrades to major renovations or even just complete redevelopments. The goal of the value-add strategy is to create additional value through improvements, resulting in increased rental income and ultimately higher property values. Yield on cost is an important metric because it provides an apples-to-apples comparison between core plus, value-add, and opportunistic deals by showing what each asset will throw off in net operating income once the property has been stabilized. This is great for somebody that's investing in a value-add deal because it can help you evaluate the potential return on the investment after making the improvements to the property. In a value-add deal, the investor typically acquires a property that's underperforming or is in need of some improvements such as renovations or better management practices in order to increase the value and generate higher returns. However, these improvements often require additional investment, and that can take time to complete as well. And as a result, it can be difficult to accurately predict the potential return on investment. Yield on cost can help solve that problem. Yield on cost can help an investor better evaluate the potential return on their investment by taking into account the cost of the property and the expected rental income after the improvements have been made. By calculating the yield on cost, the investor can estimate their annual return on their investment based on the original cost of the property rather than just the current market value. And this can help the investor determine whether the investment is likely to be profitable and whether it's worth the additional investment required to improve the property. Ultimately, you're trying to drive the best risk-adjusted returns. If you're putting a ton of time, energy, and effort into the property, adding more risk to the investment at the outset, you want to make sure that you have a suitable return on the back end to justify the additional risk that you're taking. If you guys are enjoying this video and want more tips on maximizing your investment portfolio and minimizing your tax burden, make sure to hit the like button and subscribe to our channel. Yield on cost can also help the investor compare the potential returns of different value-add deals and determine which deal is likely to produce the highest return on investment. And that can be particularly helpful when evaluating just multiple different types of investment opportunities and trying to determine which one is the best fit for the investor's financial goals and your risk tolerance. Overall, yield on cost is a useful metric for investors in a value-add deal because it provides a more accurate picture of the potential return on investment, which can help the investor make more informed investment decisions. To dive a little bit deeper into the equation that I breezed through a little bit earlier in the intro, let's define some terms. Calculating the yield on cost involves two main components: net operating income, otherwise known as the NOI, and total acquisition cost, TAC. Net operating income. NOI is the annual income generated by the property after deducting operating expenses such as property tax, insurance, maintenance, and management fees. It doesn't include any of the financing costs such as mortgage payments or interest, and it doesn't include capital expenditures either. The total acquisition cost includes the purchase price of the property, closing costs, and any of the additional capital improvements made to the property. Those capital improvements can include renovations, upgrades, and repairs that add value to the property and increase the rental income potential. To calculate the yield on cost, simply divide the NOI by the total acquisition cost. Is this use case for value add and opportunistic development deals becoming a little bit clearer for you? Several factors can impact yield on cost, including the rent expenses and the property value. The amount of rental income a property generates is a significant factor in determining its yield on cost. Higher rents result in a higher NOI, which in turn leads to a higher yield on cost. Therefore, investors should look for properties with strong rent growth potential, as that'll obviously potentially impact the yield on cost over time. As far as expenses, operating expenses such as property taxes, insurance, maintenance, and management fees, they directly impact NOI, and consequently they impact the yield on cost. Investors should carefully consider expenses associated with the property and look for ways to minimize these costs, as lower expenses will lead to a higher NOI and obviously a higher yield on cost over time. The original acquisition price also impacts the total acquisition cost of the property. A higher purchase price will result in a higher TAC, potentially reducing the yield on cost. Investors, they should carefully analyze the property value and ensure that they're paying a fair price for that property based on its potential for value-add improvements and future rent growth over time. Yield on cost is a useful tool for comparing different investment opportunities, as it takes into account both the potential income and costs associated with the property. By comparing the yield on cost of various properties, investors can identify which deal offers the best potential returns, the best risk-adjusted returns, and they can make more informed decisions about where they should allocate their capital. To reinforce that concept of yield on cost, we'll walk through another more detailed example here. Suppose an investor considers purchasing a commercial real estate property for $1 million. After closing costs and $200,000 in capital improvements, the total acquisition cost is $1.2 million. And the property, in this example, let's say it generates an NOI of $120,000. Using the yield on cost formula, we calculate the yield on cost as follows. Yield on cost, it's going to end up being the NOI divided by the TAC, which is $120,000, divided by that $1.2 million, or 0.1, and when you multiply that by 100, ultimately it's 10%. In this example, the yield on cost for the property is 10%, which indicates a potential return on investment of 10% per year. We've got a free gift for you guys in the description of this video. Look, we're here to help as many people as possible along the way with their passive investing needs, but it's no secret that our favorite asset classes are mobile home parks and parking facilities. It's what we do every single day. It's what we know. It's what we like. It's what we trust. And if you want to learn more about what we feel, in my humble opinion, is the best real estate investment sector out there, feel free to click the link and get our free passive investing guide to mobile home park investing. Thanks for watching, guys. And don't forget to like, comment, and subscribe for more tips on real estate investing. Until next time, you be great.